Every dollar you earn is designed to lose value the moment you touch it. Not slowly, not by accident, by design. You think inflation is a glitch in the system. It is the system. And right now, you are living through the final stages of a pattern that has destroyed empires, toppled governments, and erased entire generations of wealth. This is not economic theory. This is the blueprint of collapse. And if you cannot see which stage you are trapped in, you have already lost. Here is what they do not tell you. Rising prices do not just hurt your wallet. They rewire your brain. They change what you believe is normal. They make you accept scarcity as abundance. They train you to work harder for less. And when the pattern reaches its peak, the collapse is not an event. It is a controlled demolition. The people at the top walk away. The people at the bottom do not even see it coming. You are not watching an economic cycle. You are watching a revolution in slow motion. And the weapon is price. This pattern has 5 stages. Each one builds on the last. Each one feels like progress until it is too late. And the moment you recognize where you are inside this machine, you cannot unsee it. Stage 1 always starts the same way. Something changes. A new resource floods the market. A new policy shifts the rules. A new technology disrupts the old order. It feels like opportunity. It looks like growth. But what is really happening is this. The price of money itself is being rewritten. And nobody notices until the trap is already set. In the 16th century, Spanish ships brought so much silver from the New World that the entire European economy buckled. Prices doubled, then tripled. In some regions they rose 6 times over. Wages could not keep up. People worked longer hours for the same loaf of bread. The silver was supposed to make Spain rich. Instead, it bankrupted the monarchy and spread inflation like a disease across every port, every trade route, every market in Europe. The displacement was not the silver. It was the illusion that more money meant more wealth. That illusion destroyed nations. In the 1970s, the displacement was oil. OPEC turned off the taps, energy prices quadrupled, then tripled again. Food costs exploded because food depends on fuel. Heating, electricity, transportation, all of it spiked. Families who thought they were middle class discovered they could no longer afford to be. The government printed money to ease the pain. The pain got worse. Inflation hit 15%. The value of every dollar in every wallet dissolved in real time. The displacement was not the oil shock. It was the response, the belief that you could solve a supply crisis by creating more currency. You cannot. Today, the displacement is invisible but more powerful. It is the flood of liquidity injected into the economy during every crisis. $6 trillion in stimulus. Interest rates held near zero for over a decade. Assets inflated to levels that defy gravity. Stocks, real estate, and cryptocurrencies, all detached from their underlying value. People call it recovery. It is not recovery. It is stage 1. The money supply expands. Prices rise slowly at first, and everyone assumes this is the new normal. It is not. It is the beginning of the cycle, and the cycle always ends the same way. Stage 1 bleeds into stage 2 without announcement. This is the boom. Prices are climbing, but they have not yet broken into panic. Credit is cheap. Borrowing feels smart. Assets appreciate faster than income. People start to believe the rise will never stop. This is when behavior changes. Investors pile in. Speculators enter markets they do not understand. Banks extend loans to borrowers who cannot repay. Everyone is hunting yield. Everyone is chasing the next win. And the entire system starts running on borrowed time. In the medieval period, landowners borrowed against future harvest. When grain prices spiked due to population growth and bad weather, they borrowed more. The cycle fed itself. Rents doubled. Peasants could not pay. Estates collapsed. The boom phase always looks like prosperity from the inside. It feels like momentum. But underneath, the foundation is cracking. You are not building wealth. You are building dependency. Dependency on continued price increases. Dependency on continued credit expansion. And the moment that stops, the structure falls. During the housing bubble of the mid-2000s, this stage lasted years. Home prices rose 20% annually in some markets. Mortgage brokers handed out loans to anyone with a pulse. No income verification, no down payment. People bought homes they could not afford, assuming they could flip them for profit before the first payment came due. Builders constructed more supply than demand could absorb. Lenders packaged these bad loans into securities and sold them as safe investments. Everyone knew it was unsustainable. Everyone kept playing. Because in the boom phase, stopping feels like losing. And nobody wants to be the one who misses out. You see the same pattern now. Asset prices disconnected from earnings. Real estate markets where the average family cannot afford the average home. Stock valuations that assume infinite growth in a finite world. And beneath it all, the hum of debt. Corporate debt at record highs, government debt beyond measurement. Personal debt normalized as lifestyle. This is not expansion, this is intoxication. And the hangover is built into the design. Stage 3 is where the psychology shifts. This is euphoria. Prices are not just rising, they are exploding. Rational thinking evaporates. People stop asking if something is worth the price. They only ask if the price will go higher tomorrow. This is when cab drivers give stock tips, when shoe shiners talk about real estate, when everyone believes they have found the secret to easy wealth. The market is no longer valuing assets, it is valuing belief, and belief, once unmoored from reality, has no ceiling. In 1630s Holland, this stage centered on tulips. A single bulb could trade for the price of a house. Contracts for flowers that did not yet exist changed hands multiple times in a single day. Speculation was not a side activity, it was the economy. People mortgaged farms to buy tulip futures. And for a brief, dazzling moment, it worked. Prices kept climbing. Fortunes were made in weeks. Then someone asked a simple question. What is a tulip actually worth? And the entire structure dissolved overnight. Tulip mania is taught as a curiosity. It is not a curiosity. It is a warning. And it repeats in every era under a different name. By 1720, the South Sea Company was promising investors extraordinary returns from trade monopolies that did not exist. The stock price quintupled in months. Nobility and commoners alike poured savings into shares. The company issued more stock to meet demand, then issued more. The price climbed higher, because the price was climbing higher. There was no underlying value. There was only momentum. And momentum, when it reverses, is merciless. When the bubble burst, suicides followed. Fortunes vanished. Parliament had to intervene. Isaac Newton lost the equivalent of millions. He later said he could calculate the motions of heavenly bodies, but not the madness of men. That madness is not random. It is stage 3. Right now, you are watching euphoria play out in real time. NFTs sold for millions with no intrinsic worth. Meme stocks driven not by fundamentals, but by internet forums. Cryptocurrencies that rise and fall based on tweets. Venture capital flooding into companies with no path to profit. And everyday people convinced they are early to the next big thing, leveraging everything they have to get in. This is not innovation. This is the same intoxication that has destroyed wealth for centuries. The only difference is the speed. Information moves faster. Speculation moves faster. And the collapse, when it comes, will move faster than anything in history. Then comes stage 4, profit-taking. The smart money smells the shift before anyone else. Insiders begin selling, quietly, carefully. They do not announce it. They do not crash the market. They simply take their chips off the table while others are still buying. Executives dump stock. Fund managers reduce exposure. Whales exit positions. But the retail crowd, the ordinary people who bought high, they are still holding, still hoping, still believing the dip is temporary and the rise will resume. In the Roman Empire, landowners in the 3rd century quietly converted grain stockpiles into gold and moved wealth out of devalued currency zones, while soldiers and merchants continued trading in debased coins. By the time the general population realized the currency was worthless, the people who understood the system had already escaped. This is not conspiracy. This is information asymmetry. Those closest to the machine see the gears slipping first, and they act while everyone else is still hypnotized by the spectacle. During the dot-com collapse, insiders at companies like Pets.com and Where Then sold millions in stock in the months before implosion. Retail investors, watching stocks climb, kept buying. The insiders knew the business models were fantasy. The public did not. By the time CNBC was calling it a crash, the people who built the bubble were already out. This happens in every cycle. The profit-taking phase is invisible until hindsight makes it obvious, and by then, the damage is done. Look around you now. CEOs cashing out at record rates. Hedge funds reducing equity positions. Real estate investors selling into strength. And the headlines still scream optimism. The crowd is still buying. The euphoria has not yet broken. But the exit doors are narrowing. And when everyone realizes at once that the only move left is to sell, there will not be enough buyers to catch the fall. Stage 5 is panic. This is where the pattern completes. Prices do not just stop rising, they collapse. Assets that were worth everything yesterday are worth nothing today. And this scramble to sell turns into a stampede. This is not gradual decline. This is free fall. Margin calls trigger forced liquidation. Forced liquidation drives prices lower. Lower prices trigger more margin calls. The machine eats itself. And everyone caught inside is crushed. The French Revolution did not start with guillotines. It started with bread prices. The government, drowning in debt, printed paper money called assignats. At first, people accepted them. Then prices doubled. Then tripled. Merchants refused to sell goods for paper. Riots broke out. Warehouses were looted. The currency became so worthless that people used it as wallpaper. By the time the government tried to restore order, the social contract was already shredded. Inflation did not cause the revolution. It was the revolution. And when the dust settled, the people who held land and gold survived. The people who held paper did not. In 1923 Germany, hyperinflation reached levels that erased entire fortunes in hours. Workers demanded payment twice a day because money lost half its value by evening. A loaf of bread cost billions of marks. People burned currency for heat because it was cheaper than buying firewood. Life savings accumulated over generations vanished. The middle class was obliterated, and from that destruction rose extremism, desperation, and eventually war. This is what happens when the price system collapses completely. The economic chaos does not stay economic. It metastasizes into social, political, and military catastrophe. The 2008 financial crisis showed what panic looks like in a modern interconnected system. Housing prices, which everyone said could never fall nationwide, fell 30% in 2 years. Banks that were too big to fail, failed anyway. Stock markets lost half their value in months. Retirement accounts evaporated. Unemployment spiked. Foreclosures gutted entire neighborhoods. And the response was to inject more money into the system, more liquidity, more stimulus, which set the stage for the next cycle. Because the panic phase does not fix the problem, it just resets the board for the same game to start again. You are not in stage 5 yet. But you can see it on the horizon. The cracks are visible. Inflation is back and central banks are out of tools. Debt levels are unsustainable and there is no political will to cut spending. Asset bubbles are massive and built on the assumption that interest rates will stay low forever. But they cannot. And when rates rise, or when confidence breaks, or when one domino falls and takes the rest with it, the panic will not announce itself. It will simply arrive. And it will be too late to adapt. This brings us to where you are right now. You are somewhere between stage 3 and stage 4. Euphoria is fading but has not yet turned to terror. The insiders are moving, but the crowd has not noticed. Prices are still elevated, but cracks are forming. You can feel it if you are paying attention. Grocery bills that do not make sense. Housing costs that devour half your income. Savings that buy less every year. You work harder and fall further behind. This is not your failure. This is the system functioning exactly as designed. Here is what you need to understand. The pattern does not care about fairness. It does not care about your new Lee. It does not care if you played by the rules. The mechanism is mathematical. Too much money chasing too few goods creates inflation. Inflation destroys purchasing power. Destroyed purchasing power creates social instability. Social instability creates collapse. And collapse creates the conditions for the cycle to begin again. You cannot vote your way out of this. You cannot work your way out of this. You can only position yourself to survive it.